Ahead of the Nigerian Monetary Policy Committee meeting slated for next week. Joining me for an outlook of Nigeria's macroeconomic picture is Babatunde Obaniyi, a principal associate at UBA. Babatunde, thank you so much for joining us. Well, let's take a look at inflation. Yeah, thank you so much. Let's take a look at inflation. Now, January year-on-year, inflation was down to 9%. Now, some say it's early to talk about it, but what's your expectation for the month of February? I mean, I know the figures are expected on Monday, but let's just hear your thoughts.
Thank you very much for your question, Onyi. The National Bureau of Statistics is expected to come out with the inflation figures for February, on Monday, the 18th of March. And the consensus, going by the fellas in the market, is that there is likelihood of an upward trend from what we've seen in January. For January, the inflation hovered around 9% mark. But we're expecting to see 50 to 100 basis point markup from that levels we saw in January. The major reason we have taken this position or this view is hinged on that we need to look at where we were last year, because that was year-on-year comparison, meaning that we need to check the January 2012, what happened in the economy during that period and what happened in January 2013. And we need to remember that in January 2012 there was this removal of subsidy, and that cascaded. The effect of that was that we had upward tick.
Well, that's
February 2013, we're expected to settle around 9.5 to 10% mark.
Well, apart from the February number, how do you see inflation trending in the rest of this year? If the MPC maintains its current tight monetary policy.
Well, for the rest of the year, the CBN has said that they are targeting to maintain in our single digit. They've set a very high target of meeting in our 6%, which we think is feasible. But like you rightly said, that also will, there are some other factors that will come to play. We will seek to see the outcome of the decision of MPC when they meet sometimes early next week as well. And there's so many other parameters that will really come to play. The budget has just been signed, which we feel the spending, that begins to trickle down to the spending pattern of the macroeconomic constituency. We also feel that, the removal of subsidy, which is anticipated will happen this year, FDI, an increase in liquidity, all these factors are expected to affect inflation. The single digit is feasible, but hoping to get to the 6% mark is something we are not sure can be done this year. But we can do 8, 9, and that's what we expect for the rest of the year.
Well, what are your thoughts on the Naira going forward? Yesterday it closed at 158 Naira 50 kobo to the dollar.
Well, our thoughts are kind of mixed. First, we have to look at the macroeconomic parameters in the local environment. We seem to have more liquidity in the system. But we also need to factor what's coming on from outside. We have the increased FDI, which will soften the demand for dollar. We know that we have foreign players coming to our fixed income market and doing investment. So hopefully we believe that the CBN will be able to maintain the 3% band around the 155% mark that was used in the budget. But we don't expect more than 1 or 2% depreciation in the currency for the rest of the year.
Well, let's shift our focus now to the banking sector. The banking earnings season is upon us, and we could see banks release as early as, say, tomorrow. There are two issues people have noted that could affect bank earnings. The first is the impact of the increased contribution of banks to fund AMCON, and the second being the impact of central bank's new policy on capital adequacy for lending to the public sector. Now, how do you see these two issues weighing on bank earnings going forward?
Well, let me take the first issue of the funding of sinking fund of AMCON by the banks. We really do not see any major impact on profitabilities or performance of the bank as a result of the decision to move the rate from 0.3% of total assets to 0.5%. More so, when we actually did a market intelligence to get the market pulse, we found out that the 0.5% is only going to be effective come 2013. So for the provision of 2012, it's still going to be 0.3%. And once you look at that, it comes to about 3% of the total operating cost, which we do not see will have a major impact on the operations of the bank. It's something they've done in 2011, it's something they've done in 2012, and they affect the performance. And what we've seen in 2012 up until quarter 3 for the performance of the banks we've seen, we are very bullish, and we feel that this should not be a major determinant on the performance of the bank. Now, on the second question on the capital adequacy and the restriction of lending to government, saying that you have to provide, you have to mark it up to 200% from 100%. We honestly think that that's a right step in the right direction, as long as the CBN is also trying to make sure that the sector is formidable to underwrite the risk is exposed to. We say that that's a very right direction, the right step. But we also need to look at the other side of the coin. What does that portray for the private sector? Because what we had in the past is that due to that, the large exposure of these banks to the government or the public sector, there seems to be like a crowding out effect on the private sector. So what this has done is that there will be a correction of that, where there will be inclusion of the private sector and the credit that's been created going forward. And to now balance the equation, that also creates an activity in the capital market, meaning that the government agency, the subnational, the sovereign, the state government can actually come to the capital market to raise funds for the project that they might have now that the yields are looking good. So for us, it's a win-win. It includes the private sector in the lending pattern of the economy, and it also creates activity in the capital market for the state government and the other agencies of the government to raise bond and borrow.